Recession. Is it time to sell off all your crypto? When a recession hits, the streets are red with blood. All asset classes like gold, stocks, and bonds register a sharp decline. Unemployment skyrockets and inflation comes into the picture even more. We see massive layoffs from big companies and the overall market sentiment is, well, kinda eh. In this video, we will examine the effects of a recession on cryptocurrencies. We will review historical data on how crypto has reacted to periods of slow economic growth and what 2023 might have in store for the economy and cryptocurrencies. At the end of this video, we'll talk about what you need to do as a crypto investor during this recession so that you can turn out to be a millionaire when all of this ends. Because believe it or not, all bad things end, and so will this recession. Before we jump in, make sure to check out our in-depth course on crypto trading, which is attuned to beginner crypto users. In this course, we take your hand and help you make 10 to 100 times returns on your investment without taking too much risk. Since we are in a recession, now is the best time to invest in cryptocurrencies and other high-yield assets. So it's a great time to purchase. Also, please ping that subscribe button so that you can receive awesome home crypto videos like this in the future. Let's talk recession. The first question is whether we have entered a full recession. According to experienced economists and financial data, it seems that we have. A recession is loosely defined as 2 consecutive quarters of negative GDP growth. For those who don't know, GDP is the total amount of goods and services produced by a country. So the total of everything made in the United States will represent its GDP. As a rule of thumb, GDP growth is a positive economic indicator. According to the last GDP numbers published at the end of July 2022, the US has registered 2 consecutive quarters of GDP growth, marking the start of a recession. In a recession, the price of goods and services or inflation increases, and so does unemployment. This primarily means that citizens are forced to dip their hands in their savings and even pause their investments for a few months. For now, the Federal Reserve has been increasing interest rates for the past few months, incentivizing US citizens to save more and put money in the economy. However, as we'll find out in the latter part of this video, this is not sustainable. Now that we have established that we have officially entered a recession, the next question is how the recession will affect the crypto market. Let's start with a bit of history. Since the inception of Bitcoin in 2009, it has not seen a full-blown recession. So we have no accurate historical data to work out what effects the recession would have on Bitcoin and other cryptocurrencies. However, there have been 2 instances when the US economy registered 2 consecutive quarters of negative GDP growth. This can help us understand how the crypto market reacts in periods of slow growth. These instances were in 2015 and 2018. In 2015, the GDP growth slowed down and bottomed out at around 0.1% in the last quarter of 2015. During this time, the crypto market was also highly affected, registering a 70% fall from the beginning of 2014. The second example is 2018. During this time, the nation's GDP growth was almost negligent. If you had been around that long, you would have remembered how bloody 2018 was for cryptocurrencies. The total crypto market cap fell from $750 billion to $107 billion, translating to an 85% decline. During this time, Bitcoin fell from $19,000 to around $3,000. However, these patches of red in 2015 and 2018 were relatively small. According to renowned macroeconomist Raoul Pal, we are about to see a prolonged period of 3 to 4 years of slow or even negative economic growth for the US. But why is crypto so highly affected by a recession? There are 2 reasons. Number 1 is that the central banks will decide to raise bank interest rates whenever a recession is looming to pull the economy out of this phase. When interest rates are raised, people will move their money out of crypto and into commercial banks that give them a decent return without any volatility. As money moves out of crypto, the crypto market cap shrinks, and so do prices of the big coins like Bitcoin and Ether. The second reason is narrative or public sentiment. When a recession hits, consumers get highly cautious about their investments. At the start of a recession, almost all asset classes like gold, bonds, and equities will show red because investors fear what is to come. When prices start falling in crypto, a cycle of falling prices is triggered, which results in the shrinking of the crypto market cap. However, once it hits rock bottom, crypto prices will recover as money moves back from commercial banks into high-growth assets like technology stocks and crypto. Why does this happen? Well, quite simply because the increase in interest rates is not sustainable for central banks. After attempting to spur investment by increasing interest rates, the Federal Reserve cannot keep up with its policies and goes back to decreasing interest rates. Money starts flowing back into crypto and we see some relief. We might also see some short rallies, but we will not see a sustained increase in the prices of crypto assets while the economy is in bad shape. According to Raul Pal, we are still at the start of the recession, and it will get horrible in the next few months. Raul says the economy will get really bad from February to March 2023. We will see a mass sell-off and sudden fall in the economy's conditions. As always, this is not financial advice, and you should not blindly believe these analyses. The real question is, now that you know that the economy will be terrible in the next few months, what can you do with this information? Recessions and crypto bear markets represent once-in-a-lifetime opportunities for becoming a millionaire. If you had invested $1,000 in Bitcoin when it hit a low in mid-2015, that $1,000 would have been worth more than $80,000 by 2017. Let's say you bought the bottom of the 2018 crypto winter. That $1,000 would have been worth nearly $20,000 if you had held on until Bitcoin hit a new all-time high in 2021. And that's just Bitcoin, the biggest asset on the market. Whenever crypto markets stay down for a sustained period, this is a massive opportunity to start buying the cryptos you think will survive in the long run. There might be a chance for you to take returns in the short term when prices go up, but I would highly encourage you not to do that and play the long game, especially if you are a beginner trader. The best method is to dollar cost average till the time of the Bitcoin halving, which is scheduled for 2024. If you don't know, Bitcoin halving is the event where the profits of Bitcoin miners who are responsible for validating the Bitcoin network are halved, and this event marks the start of the next bull market, which we might be able to see sometime in 2025. To wrap it up, 10 to 15 years from now, when crypto becomes a major asset class and Bitcoin is viewed as a store of value, we might see a change in this relationship. But for now, the crypto asset class is highly correlated with a recession. Please remember that we are not fortune tellers, and all the predictions made in this video can be wrong and are primarily based on historical data. So use this information wisely and remember that no one can predict when the price of cryptos will go up or down. Stay safe, and we wish you all the best on your investing journey.